All right. Hi, everyone. Thanks for joining the real estate speaker series. I'm so thrilled to have Amanda and Matt join us today. They are the managing directors of Keystone CPA. And more than that, they are active real estate investors and they are CPA specialists. A lot of times, new investors have questions around what are the tax, how can I take advantage of the tax code for my real estate investments to accelerate, power them up more. And that's why I'm so excited, Amanda and Matt, that you chose to join us today to educate us more and become confident, even more confident real estate investors. So with that, let me hand it off to you, Amanda and Matt.
Awesome. Well, thank you so much for having us, Shalini, and nice to meet you guys. We're really excited to be here today. It is busy season for us for all of the clients who didn't get to file by April 15th. So I think taxes are on the mind of a lot of people. We'll talk today about what some of the tax benefits of real estate are, but first a little bit about ourselves.
Yeah, thank you, Shalini. We appreciate everybody kind of joining us today because I know it is your lunch hour, so you guys must really want to hear about taxes if you're willing to give up your lunch hour for this. But
this is lunch and a show. You
Yeah,
get to watch the show.
But yeah, we are just a little bit of background about us. We are tax strategists and CPAs. We've been in the industry over 20 years. We are married to each other, so we talk taxes all the time. Super fun. But we are, we have a team of professionals here that, our team that helps do real estate tax planning, consulting for, real estate investors. I mean, I think probably 80, 85, 90% of our clients are involved in real estate in some fashion, whether it's full-time kind of doing full-time investing or full-time fix and flip, or even the opposite extreme where they, work the W-2 job and they invest their money to grow their wealth on the side and stuff. So it kind of runs the gamut, if you will.
Yeah. So one of our passions is to really educate people on the tax benefits of real estate. And that's what we're hoping to do here is to basically share some of the tips and strategies that our clients use. But we also wrote 2 books that you can find. It's published by Bigger Pockets in case any of you guys, are members of Bigger Pockets or follow that website. But you can also just find it on Amazon too for any of you, who like to learn more about taxes. I promise you it's not going to put you to sleep. We did it in a way that doesn't involve a lot of tax codes and citations, and it's just in plain English for you to check out. So let's go ahead and get started. Yeah. So, one of the things that are on people's mind right now is inflation, right? We see it all the time going to the grocery stores. I just read an article from Wells Fargo this morning that said inflation is causing the cost of tailgates to increase.
Tailgates.
Yeah, tailgates. That's
like tailgate parties or tailgate trucks?
No, tailgate parties.
All
like
right.
The cost to fly to a game and buy the alcohol and food. So anyway, apparently people care about
you gotta
that.
do what you gotta do. Okay.
And something that's really, really interesting I learned recently is that the 2 of the biggest wealth killers are actually inflation and taxes. And I think for us, we always knew tax was a big wealth killer, right? It's one of the, we lose more money to taxes than we do on all sorts of, housing.
Sorry.
And oops.
Screen's going crazy.
We lose more money to taxes than we do on actually food, clothing, and housing combined. That's the research result from taxfoundation.org. And but what I didn't know was that inflation was the other 2 biggest killers of wealth. So that's something new to me. I wanted to share that with you guys. And I know, for a lot of you guys here, you're, probably high income earners. So I imagine, and for those of you in California too, I imagine taxes are a very big part of your expense. Higher income individuals in California, not uncommon to lose 40 or even 50%. So something important to know, and what's really interesting is that we'll talk about that today, is that real estate is one of the asset classes that can protect you from both inflation as well as taxes, right? So real estate being the kind of the hedge or solution to the two biggest wealth killers. Now, why do people invest in real estate during inflation? One is because as inflation occurs, so do the price of real estate, right?
But along those lines, also the other benefits you get to increase your rents, right? You can raise your rents to keep up with inflation. And this is especially true for kind of like short-term rentals, which we have a lot.
What else? Debt. Right?
Yeah, debt. Yeah, the debt becomes cheaper to an extent, right? I mean, your $100,000 debt may have seemed expensive before, but it actually becomes a little bit cheaper as with the inflation.
Yeah. One of the things I think people say, like a lot of investors or clients will say, like, well, inflation sucks, I'm paying more for stuff, but I'm also getting a raise at work, which is good, right? We're all happy about that. So maybe if the price of everything doubles, but then my W-2 income doubles, then I'm kind of at the same place. Well, first and foremost, W-2s are not doubling, right? Maybe we're getting a great raise, but probably a lot of you guys aren't, getting like doubling of W-2. What a lot of people don't think about though, is that the appreciation, the increase in inflation and increase in wages don't necessarily even each other out. And the reason is because we have a tiered tax rate system for the US, right? So for example, if you used to make, if you used to make $100,000, maybe you were in the 15-20% tax bracket. But if you made over $200,000 now, maybe you've been pushed up to over 20% income tax bracket, right? So you can see how with increase in wages doesn't necessarily equate to more money in our pocket. In fact, it usually means more money you're paying to taxes.
Yeah, so now that we've covered all those exciting and uplifting topics, right? It's obviously important to understand, we can't do anything. We can't really, you and I can't control inflation. There's nothing we can do about that. But it is important to understand that there's something we can do to control taxes. And real estate is one of the best ways to do that. I mentioned, most of our clients are in real estate investing. That's our background. That's what we understand. That's what we're passionate about. And so that's what we're going to kind of dive into today for you guys.
Yeah. And, we're real estate investors ourselves. So from small single family, we're also passive investors too in other people's deal. And we'll touch a little bit about, what that means if you're someone who's only doing passive investment versus doing your own properties and short-term rental. So we'll kind of cover a little bit of all the different things that we see. All right. So let's go ahead and get started. Like Matt said, the bulk of what we're talking about today is not inflation. It's going to be about taxes. And so, the first step to maximizing your tax savings is to really make sure you're capturing your tax deductions.
Right.
And I think for a lot of investors, especially newer investors, the question is always like, what can I deduct? What can I write off? Right? That it's like so confusing. And so from an IRS perspective, the requirement is that an expense has to be reasonable, and ordinary and necessary for your business. And so even though we're all investors here, we might have a different necessary real estate expense than Shalini, for example, right? And so when you're spending money on something, always ask yourself, is this something that's ordinary and necessary to my real estate business? If so, make sure you are tracking that somehow, because if you don't track it, your tax preparer is not going to know you spend money on that, right? So you're kind of the first line of defense.
And I think along those lines too is all of you real estate investors, you guys got to kind of change your frame of mind, right? You guys are all business owners, right? We have a CPA practice. That's clearly a quote unquote business in most people's eyes. But a lot of people don't think about being a real estate investor is also a business. And so that benefit gives you the ability to kind of shift some of those expenses that maybe were personal expenses before into legitimate business deductions now, because you apply those tests that Amanda was mentioning. Is this something, office supplies? Is this something that's ordinary and necessary and reasonable for my business? Or, car expenses is a big one, right? You're a real estate investor, you're going out and looking at properties, you're going out to meet with a real estate agent, you're going to go meet with, potential investor, whatever it might be. Now those mileage now become tax deductions for you. Another great one is a home office. That's probably one that gets overlooked the most.
Yeah, I think everybody has a home office now, right? Especially with
Yeah.
work from home, you kind of have to.
Yeah, if that's not ordinary necessary anymore, I don't know what is. But yeah, that's probably one that's the biggest overlooked one. And with home expenses, obviously a lot of us know, if you're paying mortgage, interest, or property taxes, we all know that we can deduct, some or all of that, right? But now when you have a home office, what it does is it converts some of those otherwise non-deductible personal expenses for insurance, utilities, maybe cleaning your house or repairing your house. Those are all just non-deductible personal expenses usually, but now it converts at least a percentage of that or a portion of that into a legitimate business write-off. And it's not uncommon for us to see a home office deduction add up to $2,000, $3,000, $4,000 deduction. So the savings can add up pretty quickly.
Yeah, I think for those, those of you who are, in California, right, or Northern California specifically too, I mean, if your household expenses are high, mortgage, rent, cleaning fees, all those are high, then that means it's going to save you more in terms of potential tax deduction, right? Because it's like Matt said, taking a portion of it and turning it from non-deductible into deductible expenses. Matt mentioned car expenses. This year, we'll talk more about depreciation in a moment, but this year there's still the 100% bonus depreciation. So, a lot of times we have investor clients who, if they bought a new car and they're using it primarily for their real estate business, that they can take a pretty significant write-off to reduce taxes. When we kind of use the word business, but what we want to make sure we clarify is business just means you're in the business of real estate investing, right? If you own rental real estate, you are a real estate investor. That in itself is a business. It doesn't mean you have to go out and form an LLC or a corporation in order to take these expenses, right? There's a lot of myths out there where people say, oh, you can't write things off until you have an entity, and that's absolutely incorrect. So as long as you're in the business of real estate, and these items, if they're necessary and ordinary to your business, then these are business expenses that can offset rental income. Okay.
Yeah, again, at the end of the day, I think it's very, very important that you are tracking these expenses because, again, if you're not tracking it, your tax preparer obviously is not, right? So they're not going to know that what you spent your money on. And so very important to not overlook these deductions because, again, they can add up very, very quickly.
Yeah. And for those of you with kids, one of our favorite strategies is to shift income to your kids. So if you have, older kids who can help you out in your real estate business, whether that's helping with turnovers or helping you to create marketing material, or, kids are really good at social media now. So maybe your kids are helping you with social media and how to, attract investors or, anything related to maybe you have a short-term rental. So if they're helping out in your real estate, you might want to consider paying them, right? Instead of just giving them money for their allowance or whatnot, if you're paying them to help you out with your real estate, you can take a tax deduction for it. And that will help reduce taxes at your level. For kids, if they don't have a lot of other income, that money they earn might be free from income taxes too. So, if someone paid their kids $10,000 and they're in the 40% tax bracket, they might be able to save $4,000 in taxes just by shifting income to the kids, right? So I'm sure you guys will have questions about income shifting. That's always a popular topic. So you can put it in the Q&A box and we'll make sure to get to those later on.
So here we can see is kind of just a fun little slide of according to these are various court cases where, maybe certain things you look through this list, it doesn't seem reasonable, ordinary, necessary, reasonable for somebody to deduct, pet food, wigs, whatever, right? But these are actually these are various court cases where taxpayers took the IRS to court and actually won and were allowed to take deductions for these various items. Now, obviously, these may not apply to everybody, but it gives you the idea of the different possibilities depending on what line of business you might be in. And I think there was a few of them on here. I think the private plane was a real estate investor, if I remember correctly. apparently he needed to have a private plane to fly across the country and look at all his properties, so don't we all, right? But
yeah, the girlfriend one was actually an investor who paid his girlfriend to help out in the real estate business, and the tax court said no, you cannot be giving money to your girlfriend, right? You can't take a deduction for it. Just kind of like how we say if you give money to your kids, you can't take a tax deduction. But ultimately, he won in tax court because he was able to show that the money he gave to his girlfriend was actually payment for her helping out in his business. So we just share that so that you can get an understanding of what are some of the things that you can deduct, right? Doesn't mean that you specifically can deduct your wig or an airplane, but when you're spending money, ask yourself, is this reasonable or ordinary and necessary for my business? And if you're spending a significant amount of money on something, have a conversation with your tax preparer. Ask them, right? Can I deduct this? Or better yet, ask them, how can I deduct it? Because they'll put both of you in a more strategic mind frame. Yeah.
Well, now, obviously, for real estate investors and tax planning, I mean, we can't talk about tax savings for real estate investors without talking about depreciation. I mean, it's probably one of our favorite topics. It's kind of one of the gold mines, if you will, from a tax planning perspective. And the reason being is that the IRS, even though you're going into buying a property, obviously hopefully for cash flow and appreciation, the IRS actually allows you to take a write-off every year as if the property is depreciating value. It's going down in value because of normal wear and tear. So even though it could be actually going up in value, the IRS is going to give you an expense every year for a part of the purchase price. And this is why we kind of call it like a paper loss, right? It's something that you didn't necessarily pay for every year, but you're getting to take a tax deduction on it. So in a perfect world, we've got, cash flow positive, but with depreciation expense, at least bringing that down to zero in your tax return, so where they're not paying any taxes on your cash flow. That's kind of the holy grail, if you will.
Yeah, what's really interesting, so depreciation is a calculation based on the purchase price of the property, and that is irrespective of how much down payment you make. Because sometimes people ask us like, well, am I depreciating my down payment, or what happens if I have like no money down real estate? And the answer is the depreciation is actually the same, regardless of how much money you put down. So as an example, if I bought a property for $150,000, and let's just say the building component of that is $100,000. This year, with bonus depreciation, accelerated depreciation, your first year write-off could be as high as $30,000. Okay, so that means, and this is true regardless of whether that $150,000 property was purchased all cash or no money down or 20% down. It doesn't change the calculation itself. It's strictly based on the purchase price and how much of that purchase price is for the building. And in that example, if we created, for a $100,000 property, if we have $30,000 in first year depreciation, that means the first $30,000 of net taxable rental income would effectively be tax-free, right? You don't have to pay taxes on that. So far we've talked about maximizing write-offs, right? Like home office and car and shifting income and, deducting your business travel, all that stuff. And then you add that on top of depreciation, right? So let's say a $30,000 depreciation for a $150,000 property you just bought. Odds are you're going to have a loss for tax purposes, right? So like Matt said, we have positive cash flow, but for tax purposes, because we're using all the strategies, we actually end up with a tax loss. So the next question then becomes, what do we do with the loss, right? So if we have, if we don't have a loss and our property is cash flowing really great, then for all of us on this call, regardless of, how many hours you're working or what you're doing in real estate, that's already great. That's already better than what's currently going on because, before real estate, if you have W-2 income, you're paying federal and state income taxes, right? Not really a way around that. It's just W-2. But if you have real estate and you're generating $10,000, $20,000, $30,000 of cash flow, the odds are if you're using these strategies, you're paying no taxes on it, which means the entire earnings from your real estate can be reinvested to grow for more real estate, right? More cash flow, more appreciation. So that's one of the reasons why, real estate is one of our favorite wealth vehicles because you get to redeploy that money without paying taxes on it versus, W-2 or maybe even other business income where you have to pay taxes, right, outside any strategies.
Now, Amanda mentioned, the question of, okay, if we did a great job with our tax strategy, we've got all these these losses that we created. One way to use those losses is if, you are a passive investor, you're investing in your deals, you got a loss on one rental, you can use that to offset positive income from another rental, or maybe you're a passive investor in a syndication deal that's kicking off positive income. So now you can use that loss from your rental property or rental properties to offset the income from your syndicated investment that you put, your passive money investor in. So that is one way to use it. That's again shows kind of the power of maximizing your deductions for those passive activities at the very least.
Yeah, it's interesting because I think for any of you who are investing in California, or not even California, like all over the US, real estate prices have gone up. So if you are planning to exit a deal, right, I'm selling one rental property, there are ways to use your other properties, right, to offset the gain on this property that you've sold. So you can kind of look at real estate as a one whole bucket and be able to offset some of these gains indirectly too, right? But let's just say, what if you don't have no other real estate? You've already, wiped out all the taxable rental income from your rentals. Then the next question is, what happens to those losses, right? I did such a great job planning. Now I have this $20,000, $30,000, $40,000 of a loss. How do I use it? When do I use it? The answer to that will be different from person to person.
Yeah. So again, it's painting the picture. We've got a situation where we've got excess rental losses. Maybe we've, don't have any other positive rental income or positive passive income to offset. So then question is, how do we use this to deduct against our other income, right? Our W-2, our interest, dividends, capital gains, business income, whatever it might be. Well, the IRS says that you can write off some rental losses against your other income. Generally the cap, the max you can take is $25,000. But having said that, that's if your income's under $100,000. Now, so under $100,000, you can deduct up to $25,000 of rental losses or passive losses against your other income. Once your income reaches $150,000, that cap of 25 goes down to zero. So it's basically essentially phased out. So in between 100 and 150, you can write off some. But once you reach 150, your ability to take your passive losses against your other income goes away for most taxpayers.
Yeah.
And this is a law that's, believe it or not, has been in place since the mid 80s. They have not changed these numbers. We talked about inflation earlier. They have not changed the threshold or the ceilings for these numbers since 1986, believe it or not. So it's crazy.
Yeah. So one thing really important to understand is when we say, let's say you're someone, combined, right? As a married couple, your income is 300,000. You're clearly over that 150. So 300,000 as a couple. Let's say you did all the strategies, you have a rental loss of 30,000. Well, all this means is that 30,000 is not going to offset your $300,000 of W-2 income this year, but you won't lose that $30,000 either. That 30,000 is considered a passive loss. So what happens is you can carry it forward into next year, indefinitely into the future years, and it will be used at some point to offset either rental income or when you sell a particular property, right, this loss will offset the gain on that. Or in the worst case scenario, if you sold a property and there is no gain, like we just kind of lost money on the sale, well, at that point in time, these passive losses are freed up to offset your W-2 income. Okay, so just so you know, if you're someone who is just doing real estate on the side, you have higher W-2 income, then it simply means that the tax benefits are being accumulated to help you offset future income. Now, for those of you who maybe are married and have a spouse who is not working full-time, then one of the strategies to consider is real estate professional status.
Yeah, so this is one of those kind of strategies, loopholes, whatever you want to call it. It's kind of a way to maximize and use those deductions that we just had, net loss from your rental activities against your other income. So in order to qualify as a real estate professional, and this is a tax term, okay, this doesn't mean that you have to be a real estate agent and go out and get some license. Real estate professional is purely a tax term. But in order to qualify, there's a couple tests you have to meet. One, you have to spend more than 750 hours per year in your real estate activities. One of the other tests, you need to spend more time in real estate than you do in any other jobs that you have. So meaning, if you're working a full-time W-2 job and you're spending 2,000 hours, you would need to spend 2,001 hours on real estate, which obviously would make it hard. And that's why we were kind of bringing up that situation where maybe you've got a spouse that's not working full-time that can focus on the real estate. Those are two of the main tests. Another test is what we call material participation test. Won't get into nitty gritty, but it is important, kind of 30,000 foot level. You need to be really involved, very involved in the day-to-day kind of boots on the ground of taking care of your rental properties. Now you can have property managers, but you need to be doing a lot of stuff that they may otherwise be doing. But again, overall, the benefit here is if you can qualify as a real estate professional and, maybe you and your spouse, one of them's got the $300,000 W-2, we got that $30,000 loss. The second spouse can qualify as a real estate professional. Now that $30,000 loss is deducted against your 300 grand, your net taxable income is now 270 instead of 300. And if, in that tax bracket, you're probably in the high 20s, let's call it 30% of $30,000, you're going to save 9 grand in taxes, right? So it can move the needle a lot. That $9,000 savings, we can now redeploy into another property, right? Continue real estate investing, building our wealth, generating cash flow. That's the power of the real estate professional status.
Yeah, we're going to go over an example in a moment, just so you can kind of see how this all works from an example from an actual client tax return we did. Now, let's talk about short-term rentals. Okay, this is sort of been a hot topic for a couple of years. It's funny, I was just talking to, we had a client that started short-term rental about 6-7 years ago. And at the time it was like our one client that did short-term rentals. Now, I think a big percentage of our client base are people who are doing short-term rentals. And I think for those of you who are interested or maybe already doing short-term rentals, there's some really great tax benefits. And in fact, we have some investor clients that get into short-term rentals specifically for the tax benefits.
It's funny, is every time we talk about short-term rentals, I think back to like the first time we actually ever stayed at a short-term rental was probably 2010. It's before we had kids. We went up to the mountains and it was like, this is before VRBO, this is before Airbnb. We got it from one of the other websites. And, this is way before it was popular, but now it's like everyone wants to stay and we still stay at them all the time. So it's funny to think about that we were kind of staying at these before they before they were called short-term rentals.
All right, so short-term rentals, short-term rental operators, deduction wise, we get the same thing, right? If you're traveling to your short-term rental properties, learning about short-term rental properties, entities, all that is exactly the same as long-term rentals. The difference though is for short-term rentals, a lot of times what we have to do is we have to furnish and stage the property, right? There's not like a vacant short-term rental. You just go in and bring your own sleeping bag and such. So for short-term rental operators, really important to know that a lot of the furnishing, equipment, fixtures, appliances you're putting in are eligible for 100% bonus depreciation. Okay. And so if you have someone who's buying a short-term rental, in Mammoth as an example, and you're furnishing it, a lot of those things are eligible for bonus depreciation. And so we add that on top of home office and travel and all that. And we do cost segregation on the building. You can see how a short-term rental can create a very, very significant tax deduction in that first year, right? And here's the other good news. The good news is that for short-term rental investors, if you had a net loss, you can use it to offset W-2, stocks, dividend income, even if you're not a real estate professional. Okay, so meaning we don't care how many hours you work at Adobe. We only care about material participation. So again, you don't have to be a real estate professional. As long as you can meet material participation, you can then use short-term rental losses to offset taxes from all types of income.
Right, and just to clarify, so short-term rental for tax purposes doesn't mean that you've listed on an Airbnb or Vrbo or one of those. It means that the average customer stay for the year is 7 days or less. So that's an important distinction to understand. 7 days or less, you got a short-term rental. 8 or more, you've got a long-term rental, regardless of whether you're putting it on Vrbo or one of those. But again, the benefit here is real estate professionals. We talked about, you got to get to at least 750 hours of real estate. But with short-term rentals, you don't need that. Short-term rentals, you just need to, meet one of these other tests where you're spending 500 hours a year on your short-term rentals. Now that may seem like a lot, but again, if you think back to maybe it's the year that you bought the property, you're getting it, you're going out looking for furniture, you're dealing with contractors, maybe you're doing some of the repair work yourself, getting it ready for market. You'd be surprised at how much time you can spend on a property, and maybe you have more than one too. You could have, this test can be applied on a group basis. So maybe you got 2 or 3 in the first year. All you need to do is get to 500 for the 2 or 3, and you can meet this test.
Yeah. So a couple of different ways, for material participation to be able to use short-term rental losses. One is that you spend at least 500 hours on the short-term rentals. If you can't meet that, an alternative one is if you spend at least 100 hours on your short-term rentals and nobody else spends more time than you. So an example would be Shalini spends 120 hours on her short-term rental. And then when you look at the hours by the cleaning crew or the gardener, the landscaper, the repair guy, they've only spent less than 120 hours, right? Then you could also meet material participation. Like Matt said, the key benefit of meeting material participation is now you can use all those rental losses to not just offset passive income, but also W-2 income too, right? So super, super powerful. So let's go over an example of that. I think, I don't know if any of you guys have heard, the more money you make, the more taxes you pay. That's absolutely not true when it comes to real estate investors. Okay, so we'll go over, this is the example of a client we worked with in our tax planning program about 2 years in 2020, right?
Yeah,
2020.
yeah.
So as a husband and wife, they were working in the medical profession, and they started investing. These people started investing locally to where they were. First year, they bought 2 short-term rental properties, and here's kind of the detailed numbers of their tax returns.
Yeah, so they were making good income, a little over $300,000. That first year, they were able to generate net positive rental income from their short-term rentals of 26 grand. They had a good year, did a good job of running their rentals.
Yeah, it was their first time doing real estate in general. It was funny. So they didn't own any real estate, and they're just like, oh, yeah, go all in short-term rentals. So they really wanted to get their hands dirty and just kind of learn everything and do everything themselves. So they self-managed the property in that first year, and also just to save on some cash flow too, right? So they did a little bit of income shifting. They had the kids are still very, very young. So it wasn't a whole lot, about $2,000. They captured and maximized their car and home office deductions. And this is, again, just an average client of ours that we worked with for the planning. They didn't go out and buy a new Tesla or anything that get a huge deduction, but, a decent amount, right, of write-offs. And then here's the biggest piece. They did cost segregation to accelerate their depreciation.
So on top of the regular depreciation they're getting another $245,000 from doing a cost segregation study, which you can see is very powerful, right? It's generating, with a cost seg study, for those of you who don't know, it's just a way to, again, we get regular depreciation, but it's a way to, you get company comes in, they look at your property, and they're looking for things that, instead of depreciating over the normal life of the property, 27 and a half, 39 years, whatever it is, they're saying, hey, that's more like a 5-year asset. That's our 15-year asset that should be depreciated quicker. So we're still getting the same amount of depreciation. We're just trying to take it sooner, right?
Yeah.
We're trying to increase our deductions now so we can save taxes now, reinvest that money, and kind of keep the ball rolling.
Yeah, so you can see.
And Matt, quick clarifying question. So the reason they are able to deduct this depreciation from the W-2 income is only because it's a short-term rental, right? They wouldn't be able to do this if it was a long-term rental.
So for this particular couple, because they were doing short-term rentals, they were claiming material participation, then yes, they could deduct against W-2. Now we have a lot of other clients who have long-term rental properties. They can achieve the same results if one of them can meet real estate professional status. So if you can't do it because you're working full-time at Adobe, maybe your spouse can do it, right? So those are the differences, short-term versus long-term. But as you can see in this scenario, right, this person, made more income, right? $26,000 more in income, but their taxes went down by a lot. I mean, in fact, their taxable income went down by over $254,000. right? So the saying that, the more money you make, the more taxes you pay, definitely, does not apply to real estate investors.
And again, this is from 2020, but I think at the end of the day, I think this saved them over $60,000 in taxes. So clearly that can be a nice down payment on another rental property or a long vacation if you want to.
Yeah. What's really funny about this couple is, their income was typically, was high, right? Historically, where they don't get any benefits. Like back in 2020, remember we had all the stimulus checks and all that. So initially they didn't get any because they were, higher income individuals. But after they filed their tax return, they actually got stimulus checks for the first time, because now on paper they made like $91,000 for a household of like 4, right? So you can see how it's kind of a compounding benefit. You're using the strategies one on top of the other. Home office, income shifting, depreciation, all that stuff.
They may have been more excited about the stimulus checks than the $60,000 tax savings, just to be honest here. But
yeah, that was funny because then that got the tax savings, they're kind of expecting that because we did the planning. But then they got another, the deposits of stimulus, and like, oh my gosh, it's never happened. What's going on? The government just giving me money. So we looked into it. It's like, oh yeah, that's the stimulus check that you were never expecting to get. But, one thing that's really important to keep in mind is that this didn't happen by chance, right? So it wasn't like, oh, I randomly bought a short-term rental and I randomly decided to, claim bonus depreciation and use the benefits. All of this was very intentional, right? Intentionally in the timing of when they bought the properties, how they operated it, ways to track their hours, right? It's more than just buying a short-term rental and there you go. You have to meet the hours requirements to use the tax benefits. And so that's the power of tax planning. And I think that's also one of the most common tax mistakes that investors make, is I think a lot of people are of the assumption that, my CPA who's doing my tax return is probably doing planning for me, right? He saw what I did last year. He's going to tell me what I should be doing to reduce taxes. But, how many of you guys actually have your CPA talk to you about that, right? Like, hey, here's all the strategies you should be doing. So really important to take the time to actually do tax planning. If your current tax person does planning, then great. Set up a time to speak with them before the end of the year, right? Sooner rather than later. We're already, getting to the fourth quarter. So the earlier you start to do planning, the more strategies you have, the more time you can have to implement these strategies, right? So make sure you have that conversation. And, if your current tax preparer does not do tax planning, you can always look at other firms who do planning as well, right? Like our firm, for example, we do tax planning, but there's a lot of other CPA firms that can help with proactive planning, because the tax strategies and the savings are not done when you file your tax return. When you file your tax return, you're just reporting what already happened, right? We can't now, pretend we bought a rental last year. We can't pretend we met the hours last year if we didn't. But if we bought rental properties this year, whether long-term or short-term, we certainly could do what's necessary to create the hours, to create the documentation, so that by next April, instead of paying taxes, then maybe we're getting a good refund, right?
yeah, so as mentioned, tax return filings are not not the same as tax planning. That is a big mistake. But for those of you wondering, based on this picture, a big mistake would be also doing your tax returns by pencil here, by hand. Do not recommend doing that in either scenario.
I'm sure none of you guys are doing it by hand. If you were, I would be concerned you're working at Adobe. But
Amanda and Matt, another analogy that comes to mind is the common statement, you make money when you buy, not when you sell. So that's what comes to mind looking at this, that you save on your taxes when from your planning, not so at the time of filing taxes.
Yeah, I like that. I like that analogy. So we just wanted to share. So these are some of the common strategies that all investors should be looking at, where we talked about maximizing expenses. We talked about income shifting. Income shifting, we only talked about paying your kids, but what about paying other family members, or shifting income to a corporation, right? Or a legal entity to reduce taxes. We didn't have time to even talk about legal entity planning, but that's another big part of this whole conversation too, is how should I hold my real estate? Is it in an LLC? Am I operating my real estate in a corporation? So these are all things to be talking to your tax advisor about when it comes to proactive planning. And of course, retirement investing too, for you guys probably have retirement money at work. what are some of the ways that we can redirect that money towards real estate if that's what you want to do, right? So, so that's it for the end of the presentation part. We do on our website, we have, we put together a tax savings toolkit where we talk a lot more about what is real estate professional status. We just created an ebook a month ago, specifically on short-term tax saving strategies. So these are two separate things that in the toolkit. And we also put together a tax opportunity finder. So this was created because a lot of times, investors will ask us like, how do I know if I'm overpaying in taxes? You talk about the strategies. I don't know if that applies to me, or maybe there's opportunities for me. So this is sort of a little quiz that you can take to see what your opportunity and risks are. So you can get it from our website, keystonecpa.com, or I put the QR code up there as well. But we are ready to go to your questions. Oh, I think you're on mute, Shalini.
Yeah. Thank you so much, Amanda and Matt. This was an awesome, chock load of information. Thanks for clarifying a lot of myths, if you will, around tax code and real estate investing. So for the audience, I opened up the chat, and if you have any questions, feel free to unmute yourself and ask your question away.
While we wait for the questions and stuff, maybe I'll touch on, we can touch on the Inflation Reduction Act that just was signed, when was it, last week, right? So one of the big things is the solar credit. If you're putting solar on your homes, before our credit was 26%. So, the 26% of what you're spending on the solar. So now that's been increased to 30%. So a good one. And, it was set to go down like after 2022, but now we're going to have 30% for quite some time. So those of you who are on the fence about solar, or you were trying to see if you need to get it done right away this year, that's the good news, is that, we're not as tight on timeline anymore. And then the benefit is also larger.
Well, along those lines, in case there's still delay in supply chain, getting materials and things like that. So.
Yeah.
Got it.
What else was from the Inflation Act? New audit increase. So you guys probably heard $80 billion more from the IRS and audits. So, and this, it doesn't mean that we should not use the strategies. It just means that we should be more careful and proactive, right, in implementation. So like I was saying earlier, if you have short-term rentals or long-term rentals and you're trying to claim the real estate professional or material participation, it's more than just, oh, I heard and this is what I'm going to say. You want to actually have a system and way to track those hours, right? If you're audited.
Yeah. Fawn, why don't you ask your question? I see you posted your question on the chat board.
Oh, okay. Sorry, I didn't see that I could unmute myself now. Hi.
Hi.
I was actually listening to a podcast with you guys on it. It was a house hacking podcast that I came across. I'm not sure how old it was, but I had sort of a follow-up question. I know everyone is normally trying to take depreciation, but I was just wondering, is it legal to just treat a house hack as a primary residence, like all the way through sale? It's just a primary residence. If you wanted to keep it simple, avoid taking depreciation, avoid depreciation recapture, and maybe, I don't know how you report the rental income, but is that an option?
Yeah. So you're house hacking. By house hack, are you renting out just a room within your house, or is this like an ADU that you're renting out?
Oh, interesting. I don't have the house yet.
Oh, okay.
So this is helping me plan for buying a house in Hawaii, which requires house hacking.
Got it. Well, so I think there's a couple layers here. So generally speaking, obviously, if you're collecting rental income from somebody, you're supposed to report that. Now, having said that, if it's going to, I don't know, generate a loss because you've got some expenses you're offsetting it with, maybe there's not a lot of exposure to not reporting it if that's what you wanted to do. If that's the avenue you went down, then yeah, there's no rental on your return. There's nothing to worry about, when you go and sell your primary residence, just as a primary residence. But now if you end up kind of reporting it as, you've rented out a room or a part of the house, the depreciation you do take on that, you would have to recapture upon your sale. But a lot of times it's not going to prevent you from, a lot of times people have the question, hey, I'm going to sell my primary residence. I want to use that $250,000 or $500,000 exclusion of tax-free income. Having the house hack and, having depreciation recapture on that doesn't prevent you necessarily from maximizing that opportunity of the 250 or 500 of tax-free income. So I wouldn't be afraid of it per se, I guess.
Yeah. If, to your question about, can I just choose not to take depreciation? That's actually not a choice. So, if you're reporting the income, right, which is what you should do, that's a suggestion. If you report the income, you would claim the depreciation and your, allocated expenses so that you don't pay taxes on the rental income. And then when you eventually sell, you have some recapture taxes, and recapture just means you don't get to double dip, right? You already wrote off $10,000 or $20,000 of depreciation. I don't get to claim that against my gain again. So, you'll have some taxes eventually, up to the 10,000 taxable income, right, in my scenario. So depreciation is actually not a choice. I think there's a lot of misinformation out there, even from some CPAs who tell clients like, oh, just, we just won't take it. But if technically speaking, if you don't take it and you're audited later on, they can treat it as if you would have taken it anyway, meaning you would have still paid recapture taxes. You just didn't get the benefit in the previous years. So hopefully that answers your question, Fawn.
Yes, thank you very much.
Great. Any other questions?
Maybe we put everybody to sleep on their lunch
I
break.
know everybody is so shy. Usually it's like, oh, so many questions.
Or maybe you answered them all already in the conversation.
I do have some other minor questions,
Uh-huh.
but they are just minor questions. So if someone else has other questions, they can go ahead.
Go ahead, Fawn. We don't have anything on the chat pod.
Okay. So you mentioned 100% bonus depreciation for furniture for short-term rentals. Does that also apply to long-term rentals?
Yes, yep, it does. So if you have long-term rent, 100% bonus depreciation applies to all types of rental properties. The only reason we mention this specifically for short-term is because short-term, most of the time you are furnishing it. But absolutely, if you added furniture to a long-term rental property, then you can take bonus depreciation on that as well.
And just for those you don't know, just to clarify, it does apply to like what we call, or what the IRS calls 5-year assets, which is typically furniture, fixtures, and equipment, or 15-year assets, which is kind of what we call land improvements. And it doesn't apply to the entire building itself. It's just, some aspects of it, obviously.
Yeah, so if I buy $1 million building, I'm not just going to write off $1 million this year. But with cost segregation, right, one of the things we talked about earlier, you can break out the components of the building so that you can get, some part of that $1 million to be 100% deductible.
Okay, I have a question to both of you. If you are able to touch upon like the top 2 or 3 biggest opportunities that real estate investors are not taking advantage, and the audience here, majority of them are working in technology, are high income wage earners, and are investing in real estate on the side. What are some of those top 2, top 3 that they can take action on right away?
Yeah, I think just, real estate in general, right? So when you are working full time, there's so many different ways you can invest. But if you bought a property, anywhere, USA, and you can generate cash flow without paying more taxes, that's great, right? So in in an example where you've made 30,000 of cash flow, but not pay any taxes on it, that's, more money for me to invest without having to work harder.
Yeah.
I think another one is the short-term rental route we were just talking about. So you have a short-term rental property, if it's close enough to you, or, you can create those hours and meet material participation. That's where we're seeing a lot of clients in the tech industry, right? Like you guys who are saving 50, 100,000 or more in taxes using the short-term rental strategy, right? So again, another kind of like low-hanging fruit. And for someone like Fawn, if you are buying a house and you have in Hawaii, maybe you have an ADU that you're renting out, or a duplex where you're renting out. Maybe the other side of it is a short-term rental, right? So now all of a sudden, you have your home and you have a short-term rental, you clearly can self-manage because it's part of your property, right, where you live, and be able to create some losses there too. Anything else?
I mean, I think the other thing that comes to mind is, for, a lot of our clients in the tech space, Googlers, whatever, up until a couple of years ago, if you wanted to liquidate your stock in your employer stock, for example, you were sitting on a lot of capital gains. There wasn't really a tax efficient way to do that and invest in real estate at the same time. But at the end of 2017, they brought about what they're called opportunity zones. It's a way for you to liquidate your stock, have capital gains, reinvest that capital gains into, if you can find it, qualifying assets in the right areas. It's a way to defer having to pay tax on the capital gains, and at the same time reinvesting the proceeds into real estate. So it can kind of, you meet a couple goals there, I guess. So that's an interesting strategy that people are taking advantage of as well.
Yeah.
Okay.
Yeah, that's a good one.
So Spencer, do you have a question?
I sure do. Yes,
Hi,
thank you.
Spencer.
So I have been kind of in and out of the meeting just because some things have been popping up. So if you've already addressed this, please forgive me. But I'm thinking through, so I have just one rental property and then a place where I'm house hacking right now. And I'd like to keep accumulating more and more properties over the next 5 years. But I think so that all the tax stuff sounds amazing. I think what do you guys recommend for someone like me who's going to be acquiring more properties? Because if we take those tax deductions, a lender would look at that, like the example you gave, they would look at that $91,000 as your income. So for someone like me, do you recommend not doing those types of deductions until I've acquired all the properties, or somewhere in between? I'm curious to take on that.
I think the first step is to work with a good lender who works with investors, because actually a good lender will add back depreciation, meaning they're not going to factor that to hurt your debt to income ratio. So in fact, we have a lot of investor clients who take these large depreciations, and if you're working with the right lender, they'll help you explain that to the underwriter.
That's really cool.
Yeah.
Okay.
Thank
Do you have recommendations on that really quick?
I'm sorry?
Any particular lenders that come to mind?
The lenders are so different depending on like where they, where you're investing to, right? Whatever state you're investing in. But I'll throw something into the chat box for you guys. I'll look that up while we go over some other questions. Yeah.
Okay.
Or maybe it's a mortgage broker that can shop around and find you. They're familiar with various lenders that work with investors, right?
Yeah. I'll throw in, this is a name of one of our clients who's also an investor himself. Very creative guy. I just don't know like what market area you're investing or anything, but you can reach out to him and see if it's a fit. And if not, maybe hopefully he has other friends who are good.
Well, thank you so much for that. I have Tara on the call who has a question. Tara, do you mind unmuting yourself? Thank you.
Yeah, absolutely. Actually, I just wanted to talk about what Matt was talking about with taking out money from an account, like an investment account. Currently, I have an IRA account, and I've been trying to figure out how I can take out that money for, buying my first property. I have a partner that's currently in the military, so I wasn't sure what the best route was to take out that money to do a down payment. So if you had any advice, I would love to hear.
Yeah, earlier we were talking about exiting stocks, right? So the nature of it is a little bit different, because that is that specific strategy was for capital gains from sale of stocks. In your scenario, what you're talking about is a retirement distribution, right? And possibly an early distribution too, subject to maybe taxes and penalties and things like that. So
how much are we talking about, Tara, if you don't mind sharing? Like what would you pull out?
Yeah, the market I'm looking at is in New York. So obviously it's going to be a higher, money for putting down, of course. So it's maybe depending on the house or what type of situation. I was hoping a house hack, like many of us, potentially 100,000, just give or take on what I can find in the market.
Yeah, I mean, I as a kind of a general rule, which obviously is not going to apply to everybody, it's hard for me to recommend to somebody to pull money out of a retirement account,
right,
for whatever reason, right? So whether it's to buy a primary residence, to do anything else. And the reason being is obviously you're going to be looking at paying taxes and or potentially early distribution penalties. Now, sometimes it's a first time home buyer. You can kind of get around that 10% early distribution penalty. So that would be something to look at. But then, even the income tax side of things, you can, possibly mitigate the income tax consequences from the extra 100 grand by, if you're going to say, I'm going to go invest it in a short-term rental and generate deductions that, can offset it.
Yep.
But,
Yeah.
It's a give and take, right? It's just hard to swallow that pill and do that because you've been using it, you've gotten tax deferred growth over the years. We'd love for that to stay as a retirement account. If you can find other funds to use as a down payment, but obviously, you got to figure out what's going to work in your situation.
Also, too, I mean, for 401ks, you can borrow up to 50,000 of that,
Okay.
tax-free, penalty-free. So if you need 100,000, I would borrow 50, right? Because that's kind of like free money. It's basically you borrowing from your retirement account. And then the remaining 50, I mean, if it has to be, if you must have that, there's no other, avenue for it, then
I would just rob a bank.
Yeah.
then they'll just be, taxable. Then you try to use some of the strategies we talked about today to offset it.
Perfect.
But I mean, yeah, for other people who, like not house hacking, if you're just strictly looking for, investment properties, one thing is just to consider self-directed investing, right? Not taking it out of the retirement account. I'm just investing through my retirement account. So moving that money, if we're talking about $100,000, moving it from Charles Schwab to a self-directed custodian. And then on the custodian side, after it goes to the self-directed custodian, now it goes out to buy a rental property, long-term or short-term, right? Then you start growing that money in real estate.
So Amanda, in fact, we had Karen Hall speak to this audience a few weeks ago. So
Yeah.
cool.
Awesome. Thank you.
Yeah, thank you so much. We are at the top of the hour. So Amanda and Matt, thanks again so much for joining the call today. And for everyone here, I'm taking away as a reminder, I read your first book, but I'm going to definitely check out the ebook that you just mentioned. And I see the advanced strategies in the background. So those are the books that I would definitely check out. And for the folks here, I will be sharing the meeting recording later and also, the presentation from here so that you have a way to reach out to Amanda and Matt. Thank you so much again.
Thanks, Shalini. Thanks, everybody. Appreciate it.
Bye.
Thank you. Take care. Bye.
Bye.